Hello, friends. If you're 65 or older and still working in Canada, more than $2,000 a year could be quietly clawed back through your CPP, your OAS, and tax credits you don't even know you're losing. 6 traps. The last one is the one most people get completely backwards, so stay with me right to the end. Number 1. Your employer is still taking CPP off your paycheck, even though you already collect CPP. Once you turn 65, contributions become optional, but nobody stops them for you. In 2026, the employee rate is 5.95% on earnings between $3, $574, $600. That's up to $4, $230 out of your pay this year alone. Earn more than $74, $600, and a second layer called CPP2 takes another 4% up to $85,000, as much as $416 on top. So a working senior can hand over more than $4, $600 in a single year to a pension they're already receiving. And what do you get back? A tiny top-up, called the post-retirement benefit. The maximum in 2026 is $54.69 a month, about $656 for the whole year. Do the math. You pay over $4,000 and get back $650, and it takes 10 to 15 years just to break even. Take Margaret, a 67-year-old grocery cashier in Ontario earning $32,000. She paid roughly $1,696 in CPP last year and earned a post-retirement benefit of about $9 a month. 99 cents on the dollar gone to buy pennies back. For most people past 65, that's not a boost. It's a slow leak. The people who never check their pay stub never notice it's happening. Pull out your last stub right now and look for the letters CPP. If there's a dollar figure beside it and you're already collecting your pension, money is walking out the door every 2 weeks. In a moment, I'll show you the one form that shuts it off. But first you need to know whether stopping is even the right move for you, because for a small group, it isn't. Number 2. The form that stops the bleeding is called the CPT30, Election to Stop Contributing to the Canada Pension Plan. It's 1 page. But there are rules that trip people up. You can only file it if you're between 65 and 70 and still working. Under 65, you have no choice, you must contribute. Past 70, it stops automatically and you don't need the form at all. Here's the part people get wrong. You send the original to the Canada Revenue Agency and give a copy to your employer. Your employer will not stop the deductions until they have that copy in hand. The most common mistake is mailing it to the CRA and assuming payroll is notified. They're not, and the deductions keep coming for months. If you have 2 jobs, you must make the same choice for both. You can't stop at one and keep paying at the other, and each employer needs a copy, and you can only change your mind once per calendar year. So if you file to stop, then decide months later you want back in, you're locked until January. The contributions also stop the first day of the month after your employer gets the form, not the day you signed it and never backdated. So the earlier in the year you file, the more you keep. One retiree, Bill, earning $50,000 at a part-time job, saved himself around $2,975 in a single year just by handing this form to payroll in January, instead of leaving it in a drawer until October. Those 9 extra months of deductions would have been gone for good. This week, print the Captain 30, fill it in, and get a copy to your employer. Then check your very next pay stub to confirm the CPP line has dropped to 0. Number 3. This is where the real dollars disappear. The OAS recovery tax, better known as the clawback. Your old age security isn't safe just because you qualified for it. Every dollar you earn from working stacks on top of your CPP, your OAS, and any RRIF withdrawals. And once your net income crosses $95, $323 in 2026, the government starts taking back 15 cents of your OAS for every dollar over that line. Keep going, and by roughly $155, $481, your entire OAS for the year is gone. Think about what that means for someone who takes a good contract job at 66. $15,000 or $20,000 of extra income can quietly cost you $2,000 to $3,000 in OAS you'll never see, on top of the tax you already pay on the income itself. Picture Frank, retired at 65 with $90,000 of pension and CPP, who takes a $20,000 consulting contract that pushes him to $110,000, about $14, $700 over the threshold, and 15% of that is roughly $2. $200 of OAS clawed back, so his real take-home on that contract shrinks by more than a fifth before income tax even touches it. It's not a penalty you get a letter about, it just shows up as a smaller check the following year. Net income here is line 23,600 on your return. Employment, pensions, RRIF withdrawals, rental, taxable capital gains, everything except your TFSA. That last word matters. A dollar pulled from a TFSA never counts, which is why the fix is often to draw from the TFSA in a high-income year instead of a RRIF. And here's the reminder I promised. Stay with me to number 6, because the belief most working seniors hold about all of this is exactly backwards, and it's costing them the most of all. First, a credit that vanishes so quietly almost nobody notices. Number 4, the age amount tax credit and how working quietly erases it. Every Canadian 65 and older gets a special federal credit called the age amount, worth up to roughly $1.300 off your federal tax bill each year, money in your pocket for simply being a senior. But it's income tested. In 2026, the moment your net income passes $44.325, the credit starts shrinking by 15 cents on every extra dollar. And by about $98.309, it's gone completely. That $44.325 line is low. A full CPP of around $17,000, OAS near $8,700. A small workplace pension and a part-time job can blow past it easily. So the very act of working can hand back a credit worth over $1,000, and most people never connect the two. Consider Joyce, who added a $10,000 seasonal job on top of $50,000 of retirement income. She lost the full age amount plus a slice of her pension income amount, and her tax bill jumped about $1,500 more than the tax on the wages alone. She assumed the job simply wasn't worth much and never learned why. It isn't only the tax on the wages, it's the age amount melting away in the background, and often the pension income amount and provincial senior credits shrinking right alongside it. Nobody at the job site tells you this. Your employer withholds tax on your paycheck, but they have no idea what's happening to your credits at the CRA. The fix isn't to stop working, it's to know the number. Before you take on more hours or a contract, ask yourself where it pushes your net income for the year. If you're anywhere near $95,000, every extra dollar is doing double damage, clawing back OAS and dissolving your age credit at the same time. That single piece of awareness can be worth thousands. Number 5. The timing trap that catches people a full year after they've stopped working. Your OAS clawback isn't based on the money you're earning right now. The OAS you receive from July 2026 through June 2027 is calculated on your 2025 income, the last tax return the CRA has on file, where the threshold was about $93,454. That lag creates a nasty surprise. Say you worked hard in 1 year, or sold a rental property for a $60,000 taxable gain, or made a $40,000 RRIF withdrawal, your income spikes. You feel fine at the time because your OAS keeps coming. Then a full year later, long after that job ended, your OAS check suddenly drops or disappears, clawed back on income you earned last year. Take Vernon, who sold his cottage in 2025 and triggered a big capital gain. His 2026 OAS was slashed to almost nothing even though he'd fully retired months earlier, and he lost close to $8,700 for the year on a one-time sale. People phone Service Canada in a panic thinking there's a mistake. There's no mistake. It's the 1-year delay. This matters most in the year you retire, or the year you take a one-time lump sum. If you know a big income year is coming, you can plan around it. Split a $40,000 RRIF withdrawal into $20,000 across 2 years, or time the sale of an asset, so a single spike doesn't push you over the line. And there's a form, the ISP 3041, where you can ask Service Canada to base your clawback on your estimated current income instead of last year's, if your income has genuinely dropped since you stopped working. Most people don't know it exists, and they overpay for a year waiting for the system to catch up. Number 6, the one most people get completely backwards. Ask a working senior why they keep letting CPP come off their pay and they'll tell you, "It's building my pension, so it's worth it." That belief is costing them the most of all. Here's the truth. After 65, continuing to contribute buys you the post-retirement benefit. And we saw it maxes out around $54.69 a month while you're paying over $4,000 a year to earn it. The break-even runs 10 to 15 years or longer, and many people contribute into their late 60s on money they'll never live long enough to get back. Pay in at 68 and you're often past 80 before you've recovered it. Worse, that post-retirement benefit is itself taxable income, and it counts toward the very OAS clawback we just talked about. So a benefit meant to help you can nudge you over the line and take OAS away with the other hand. For the large majority of people still working past 65, the smart move is to file the CPT-30 and stop. But, and this is the exception that proves you have to know your own numbers. If your lifetime CPP is low because you had gaps or low earning years, and you're still earning a solid income, and you're in good health with a long horizon, then continuing can genuinely raise your pension for life. Think of Ruth, 66, who spent 15 years out of the workforce raising children. Her CPP is thin, she's healthy, and each year she keeps contributing meaningfully lifts a pension she'll draw for decades. For her, staying in is the right call. So the belief isn't wrong for everyone. It's just backwards for most. Don't follow the crowd in either direction. Pull your CPP statement of contributions and see where you actually stand. So here's the one move to make this week. Log into your My Service Canada account. Check whether CPP is still coming off your pay, and if you're 65 to 70 and it doesn't grow your pension enough to be worth it, file the CPT-30 to stop. Then look at whether this year's income is creeping toward that $95,323 line. That 1 hour can save you more than $2,000. If this helped, subscribe and share it with someone over 65. The ones who find out in time keep their money.